Hello everyone, my name is Belina. I'm doing the Calmate University BUS585 test sessions, the final project. My topic is IRA versus the Roth IRA. Let's look at the IRA. IRA is an individual retirement arrangement. It also is a blanket term for a form of retirement plan that provides tax advantages for the retirement saving in the United States. The term encompasses an individual retirement account, a trust, or custodial account to set up for the exclusive benefit of taxpayers or their beneficiaries, and an individual retirement annuity, by which the taxpayers purchase an annuity contract or endorsement contract from the life insurance company. The type of the IRA. This is 5 of them: a traditional IRA, Roth IRA, SEP IRA, simple IRA, and self-direct IRA. Roth IRA. An Australian IRA is the special type of the retirement plan under U.S. law that is generally not taxed, provided certain conditions are met. The Roth IRA is an individual retirement account. It is one of the numbers of the plans allowed under the tax law of the United States that allow the tax reductions on the limited amount of saving for retirement. Traditional IRA contributions are often tax deductible, simply just as the money is deposited before the tax or contribute was made with the pre-tax assets. All the transactions and earning within the IRA has been no tax impact, and the withdrawals as retirement are taxed as income. Depends on the nature of the contributions. A traditional IRA may be referred to as a deductible IRA or a non-deductible IRA. SEP IRA. SEP IRA is a provisions allow the employer, typically small business or self-employed individuals, to make the retirement plan contributions into the traditional IRA, established in the employee's name instead of to a pension fund in the company. 4. Simple IRA. A simplified employee pension plan that allows both employer and employee contributions, similar to a 401k plan, but with the lower contributions limits and the simpler and administrations. Although it is returned an IRA, but it is treated separately. 5. Self-directed IRA. A self-directed IRA that permits the account holders to make investments on the behalf of the retirement plan. There are 2 other subtypes of IRA, named rollover IRA and conduit IRA. They are viewed as obsolete under the current tax law by some, but this tax law is set to expire unless extended. However, some individuals still maintain those arrangements in order to keep the track of the source of these assets. One key reason is that some qualified plans will accept rollover from the IRA only if they are conduct and rollover IRAs. Let's compare traditional IRA and Roth IRA. Which one is better? Deciding whether to open a Roth IRA and traditional IRA is a major decision which would potentially large financial consequences. Both forms of the IRA are a great way to save for the retirement, although each was offered the different advantages. Traditional IRA profit. The tax-deductible contributions depends on the income level, and the withdrawals begin at the age 59.5 and are mandatory. Finish to withdraw all the money by 70.5, but taxes are paid on earnings when the withdrawal from the IRA. And funds can be used for the purchase of a variety of investments like stock, bonds, CDs, available to everyone's no income restrictions. All the funds withdrawal, including the principal's contributions before the 59.5 years old, are subject to a 10% penalty. For Roth IRA, which contributes is not tax deductibles and non-mandatory distributions age. All the earning and the principals are 100% tax-free if the rules and the regulations are allowed. Follow. Funds can be used the same as in traditional IRAs. You can purchase stock, bonds, certificate of deposits, available only to the single filers making up to the 95,000 or the married couples making combined maximum of the 150,000 annually. And principal contribution can be withdrawn anytime without penalty. And let's look at the tax deferral and the tax freeze difference. The biggest difference between the traditional IRA and the Roth IRA is the way of the U.S. government treats the taxes. If you earn the 50,000 a year and put 2,000 in the traditional IRA, you will be able to deduct the contributions from your income taxes. Means that you will only pay to the tax on 48,000 in income to the IRS. By age 59 and a half, you might begin to withdraw the funds, but will be forced to pay the taxes on all the capital gains, interest, dividends, and so on, and that was earning over to the past years. If you earn the 50,000 a year and you decide to put the same $2,000 in the Roth IRA, but you would not receive the income tax deduction. But if you decide you need the money from the account, you will withdraw the principal at any time, although you will pay the penalties if you withdraw any of the earning your money has made. But when you reach out the retirement age, you will be able to withdraw all the money 100% tax-free. The Roth IRA is going to make the more sense in most situations, but unfortunately not everyone qualifies for the Roth. A person filing the tax as a single can not be made over 95,000, and married couples are better off with a maximum income of 150,000 yearly. Thank you for watching. If you have any question, consult to your banker or investor.